Welcome to another What's Up with the Market session. We're going to do a market status update and we'll do questions and answers at the end for those of you that have questions. Before we do that, I have to tell you everything we covered today is general investment advice, and there's no personal or specific investment advice that's been provided here. We are going to be looking at live price data or up-to-date end-of-day data, and nothing should be construed as direct investment advice. Right, straight to the Dow Jones. And there's the last high, the last peak, the last all-time high back there, top left of your screen. And the Dow Jones is approaching, it's about 220 odd points off its all-time high that occurred back here, top left. And it certainly is broken out of this down channel, the black downtrending channel here, sharp breakout. And the last time we met, we were talking about a little bit of consolidation and potentially a retracement just here where those red bars are over there. And there was no retracement. At the time I mentioned that that if there was no retracement, that would be an indication of strength. So just a pause is really what happened without a retracement. And that's pretty strong price action. And here we have the Dow approaching a new all-time high, where we would expect some resistance. One other thing to look at over here, bottom right, is the relative strength chart comparison to the S&P 500. And we see the Dow still outperforming the S&P 500, just a slight outperformance over the last 3 or so months. And what we would see in really bullish conditions is we would see the S&P 500 outperforming the Dow Jones, because there are obviously a whole lot more of smaller cap stocks that make up the S&P 500 that the Dow doesn't. So these are large cap stocks are slightly outperforming the broader S&P 500 index at the moment. And right, let's move on to the S&P 500. And just from a relative perspective, there is some resistance here where this blue resistance zone is. It's broken out above that in the last couple of sessions. And it's a little bit further off its all-time high top left, which is the black dotted zone that you see overhead. But it's well into this trend. So the trend, it's gone back into the zone, dropped, into the trend channel, fell out the bottom over here, maintained that, because one of the things we want to see, rather than redrawing it at that time and changing all the angles and gradients and everything, we want to see if that is a false breakout to the bottom or not, and that has been so far. We're moving not quite to the median line yet, but the median line, which is roughly, it's not typically in the middle, exact middle or median, but it just finds some support and resistance in the up channel, as you can also do in the downward trending channel as well. So it's just where there are some peaks and troughs that align with that median. We call it a median line. And volatility is low, down well below 1%. For the S&P 500, which is indicative of bull market conditions. Not much that we're getting out of the cumulative new high, new low here, except there is a slight upgradient. So what we're looking for is we want these to be in unison. We want the gray line, the blue line is the S&P 500, the gray line is the cumulative new high, new low. So there are new 52-week highs being made, or more than the 52-week lows. And we do want to see, now that doesn't really ever get to be a steep gradient, but rising is good. It can get steeper than that, but it is one of the breadth of market indicators that we keep an eye on. The other thing I didn't point out on the S&P 500 chart, which I can point out here because this is just a line chart of the previous one we looked at, is that there is a new high that's been made. Yeah, that peak over there is where the resistance was. And it is now higher than that previous peak. I might as well just go back to the chart. There's the peak over there. Now we are higher than that, which is another breakout, another confirmation of this bull market that's happening, this primary bull market that is occurring. The cumulative advanced decline line is at a steeper gradient. So we've got them going in the same direction. What we are looking for when you look at this is divergence. When you see the index rising, but the cumulative advanced decline falling. And that's that's why I got a red ellipse around there, and that's what we look for in these situations. Not present, so that's that divergence is there's no negative bearish signs there at this stage. We've got certainly above the 50 percentile of the number of stocks in the S&P 500 that are above their simple 150-day moving average. And there's the confirmation. This is the S&P 500 chart over here, and there's the breakout has occurred back there, and so we've got more stocks that are rising above their 150-day moving average. This is the chart that I put a lot of importance on. It's the US dollar so it's US dollar versus equities versus the S&P 500. US dollar is this is the red and green over here bars, and overlaid on that is the S&P 500 chart, the blue. And this is one you might remember a comment if you've been listening to these sessions often, is that this is the highest correlation I've been able to find doing an intermarket analysis between different parts of the market, different sectors of the market. And here we can see US dollar started falling and the equities, the S&P 500 started rising. So what we're looking for is continued weakness in this US dollar basket. Remember, it's measured against 6 other currencies. And so it's an indication of where the money's flowing between the US dollar and other currencies. And what we have here is when we get an exit signal. So this is doing this here is a relative strength line, this blue line, the middle one between the two. It's a ratio between the two. And then I put a trend indicator on, that's an indicator of an indicator, onto this relative strength line in the middle here between the two, between the US dollar and the S&P 500. So when this is falling, that is a bullish sign. What that means is that equities are outperforming relatively over the US dollar index. So there's an entry signal, if you like, and you can see the correlation is quite high. We had stocks rising, and then when we had this over here, when this crossover happened here, the Ciroc that I've got on the relative strength, then during that period of time we saw some weakness in the index, while the US dollar was getting stronger, weakness in equities, and now we've got that. So that's a tick. This crossover happening down here, which is bullish for equities. This is the what is this? This is the growth. This is growth versus Russell Growth Index versus the Russell Value Index. And even though we had this weakness we had for about 3 months here, we didn't get an exit signal, in inverted commas, on this, meaning that growth stayed stronger than value through this entire period, and this weakness that we had here. This is the S&P 500 down the bottom. This is the Russell Growth Index over here. So even though that was falling, it was falling by less than the Russell Value Index, indicated by this blue line continuing to rise here, which is a ratio between the two, the growth and the value index. So that's bullish as long as this stays up in this blue zone and doesn't cross down like it did over here or over here. There was a good signal over there when that crossed. So when value became relatively stronger than growth, that was an exit signal to move out of equities, or this is a sentiment-based indicator, and so a sentiment at the moment positive for equities. The other one we look at is discretionary versus consumer staple, and this also has remained bullish, even though we had the consumer discretionary falling. It still stayed stronger than consumer staple. How do we know that? This blue line continued rising. This trend indicator, however, stayed up in the blue zone the whole time. So the retracements happened on the indices. We've had around a 38.2% retracement of the run-up that started over a year ago, and that's pretty healthy. That's a sort of retracement that we like to see, and then find support there, and on the indices, and then see a bounce off, which was quite a strong V bottom off there, and some strength coming into the equity. So this is all playing out textbook for how the markets should move, and you really shouldn't. If your mindset is in tune with the market and you think from the market's perspective, then that 38.2% should have just been like water for ducks back to you in the way that you manage your portfolios, because that is just the normal occurrence of how markets work. In fact, I'll say, while I say that, I should just say that our members are a lot of you hopefully would have done the last the 4-week training intensive, the process plus mindset training intensive that I did in November. If you haven't done that, the recordings are all up, and you'll look out for an email. You'll be getting some information to do that if you haven't done it. It's I would say the best training material that we've ever produced. Right, on to put call ratio. What we're looking for here is for the there's the sell signal. So that is a sell signal on puts and calls. meaning it's a risk-on environment. So when we have the indicator falling, so effectively in the top line over here, that put-call ratio is measuring the number of puts that have been bought versus the number of calls that have been bought. Obviously, buying calls is bullish, buying puts is bearish. And so now there are more calls being bought than puts, which is indicative of bear market risk-on type environment. And what I'm doing is I'm measuring this trend following indicator, the smooth trend following indicator here of the simple moving average. It's a 250-day, 1 year simple moving average of the put-call ratio. So it's starting to dip over here, and so we take that squiggly line there, smooth it out, and this falling here is a risk-on environment. So that's bullish for stocks as well, and you can see that stocks have risen since we started seeing that indicator fall. Another sentiment indicator that is giving positive signs of the market that we currently have. Another confirmation here is looking at the 10-year Treasury. See, the 10-year Treasury has fallen got to 5% yield and found some resistance there. Has fallen back now to previous support, previous resistance, which has now become support, and it's in this rather steep downtrending channel here. And there was the risk that we still haven't had this indicator turn down. So when this relative, this SIROC, the smooth trend following indicator of this relative strength, I've got it's a medium to long term trend following setting on that parameter setting. When this drops below that comes out of that blue zone and starts falling, that'll be another indication of risk on for equities, and that would probably happen if the 10-year yield continues to fall. So pretty positive. All the sentiment, the breadth of market, a little bit of strength there, not too much, and the sentiment indicators all aligning at the moment. So I'm just going to zoom out over here so you can see where we are relative to historical past. So this is the VIX index, fear index, and volatility is low at the moment on the S&P 500, right down near, not quite record lows yet, but certainly lower than what we've had since all the way back here in December 2019 is the last time we were this low. So volatility low, again, another bullish sign for equities. Right, on to the Nasdaq. Nasdaq is there's the all-time high up there, so even further away than what the S&P 500 was away from its all-time high, which is further away from where the Dow Jones was from its all-time high, top left-hand corner over there. Now we fell out of the channel, the rising channel, back into the channel, not quite at median yet. Resistance the Nasdaq hasn't broken through this resistance zone over here. Had a couple of bashes, even probably 3 bashes in it in this period, this part of the chart here. But this relative strength line here, measuring the Nasdaq v the S&P 500. When the Nasdaq is outperforming the S&P 500, that is a more bullish environment. There's a slight downtrend over here. You can see of the just from the black trend line I put on here. So not quite much outperformance yet of the Nasdaq over the S&P 500, but this medium to longer term smooth trending indicator here of the relative strength line didn't dip through this entire fall down here. It would have said let's stay invested in stocks. There were no emergency get out signals over there on that sentiment indicator. This is a cumulative new high, new low of the Nasdaq index, the NDX, which is the that's the whole of the Nasdaq, which typically brings a lot of small cap stocks, and this hasn't quite turned yet. So, and that you can see it's a pretty bearish line. Very seldom, even when the Nasdaq is going gangbusters, which you can see there was a period over there coming out of COVID. It does rise, and that's where we get the whole market involved as a breadth of market on the Nasdaq. Certainly not happening at this stage. We want to see that sort of price action for it to be really raging bull market. So certainly not raging bull market at the moment. And this is the cumulative advanced decline on the NDX, which is the Nasdaq 100, so large cap stocks. And you can see that there are certainly more advancing than not in the Nasdaq 100 as a breadth of market. The stocks above the 150-day moving average. This is also the NDX and rising and up at around about 2/3, so that's bullish as well. And the another sentiment indicator, which is the semiconductor sector, is also now outperforming. This is relative strength to the Nasdaq. So when you've got a sector of the Nasdaq doing better than the Nasdaq in a typical kind of risky stocks environment, then you know that it's these signs are all aligning for bull market conditions in the US. What we haven't got here yet is this Siroc here. We want it to turn up like it did over there and cross above the green line. So it's a medium to longer term indication. So we're looking for confirmation here. We're not looking for jumping in and out. But this relative strength line here, relative to the Nasdaq 100, to the Nasdaq Composite, is showing a lot more strength in the semiconductor index. So that's another thumbs up for bull market conditions. Right, onto the Australian market. Lagging. There's the total, all of this period of time has been lagging the US market. The S&P 500 almost matched it there, going sideways, fell again, and it's kind of matching it a little bit now at the moment, but not enough to write home about. But it has broken out of the down channel. There was an entry signal on our mechanical system, medium to longer term entry signal here, off support, and broken out of that channel. So things are going in the right direction, but underperformance relative to the US markets. The Australian dollar it did have a breakout back here, but it's still in this downtrending channel. We want to see it break above these median lines here and get above this resistance up here. So it's still a long way off that 70 cents, which has probably been a long-term, 35-year kind of where the Australian dollar should sit relative to the US dollar. And it's some ways below that. So a little bit of strength, but certainly not hitting any home runs yet. I'm going to have a look at some of the other international indices, which I haven't done for a while. This is the Nikkei. So the Nikkei outperformance during this period of time, you have the S&P 500. Underperformance now, and it's found some resistance here. Now, that's not an all-time high of the Nikkei, because I don't have all the way back to 1989 here. It goes back to whenever it is 1998. But that is certainly for the last 39 years, or what is it now? 30 more than that, 36, whatever it is. And it's since 1989. That is the resistance, if you like, in the time frame that we're looking at, the all-time high, and it has found resistance there. And there's a little bit of weakness relative to the S&P 500. But it's kind of being treated in the Japanese market like an all-time high. It's been that long ago since the all-time high did occur. But comparing that to the DAX, Nikkei having some resistance there, the DAX has broken through to an all-time high. It's never been this high before, a couple of days ago. And there is that top left over here is roughly the same period, roughly the same time that the American markets and the Australian market hit their previous all-time highs. A number of bashes to get through here failed, broken through. There's underperformance against the S&P 500, now a breakout of that trend line, so outperformance of the American market. So that's a pretty steep gradient. We'd expect this to, if this is really going to kick on in Germany, go a little bit higher and then come back and test this previous all-time high here. That would be typical price action. There'd be some short-term taking of profits. Sellers would get into control for a short period of time, and then what we'd want to see is a support to get found and another kickoff ahead. So this is quite important for a major European market, or another major market, to be making an all-time high, and it's now leading the American market. So that's an interesting one. Not so in the FTSE. The FTSE has been a perennial underperformer, and it's just going sideways. Underperformance here of the US markets, not much more to say there. Quickly, the Chinese markets, these are the large cap stocks in China, downtrend, underperformance of the S&P 500 for a long time, and now a different gradient, even a steeper gradient of underperformance relative to the S&P 500. And this is the Shanghai All-Share Index, a broader index than just the top large cap stocks in China, also a weakness compared to the S&P 500. So China not doing well at all. Okay, we'll quickly move over now to the to the commodities. CRB index did break out, found resistance again at this resistance zone, broke out of the down channel, and now is falling as well. You can see underperformance here of equities, quite sharp. A lot of that has to do with oil. Here is gold. There was that false breakout so far looking like. Let's talk a little bit about gold. So the all-time high, top left over here, a number of attempts to get through. You could say there's one, maybe even call that 2, 3, and this now is a fourth. This is a big failure bar, and whether you put that on a candle or a bar, let's just look at it. That is an open, went higher, went to an all-time high intraday, fell back below into the range, and is now showing more weakness. And even in this period of rising underperformance against equities. Now, I have shown you the chart before. I'm not going to zoom out and go and play around with it right now, but we'll come back to it when it's relevant. Is that it's unlikely that gold will break out to a new high and have a strong trend while we still have a secular bull market conditions in play. Gold will get strong again when we have secular bear market, and it'll be one of the indicators that I'll look at as one of the sentiment indicators, if you like, one of the many intermarket relationship indicators and relationships to give us an early insight as to whether we are potentially rolling over into a secular bear market condition. Now, I'm going to talk, I've been saying I'm going to get onto this, the secular bull market update. It will definitely be next Wednesday, and we'll look at gold and a number of other things as to try and get an insight into whether the secular bull market is still continuing. There are a number of high-profile analysts around the world that have called this a secular bear market that we are currently in, meaning that when the indices, the major indices get to the Dow, the S&P500, and the Nasdaq Composite, or in Nasdaq 100, get to those all-time highs that I just showed you, the black dotted resistance line overhead, is that we might have a false breakout or get to resistance around there and fall away. So, and that would be an indication that potentially we have got maybe in a secular bear market. But I'll look at some other indicators. Of course, we don't know, we can't predict the future. But if those all-time highs get taken out and we have a strong trend above them and there's no false breakout, then all of those predictions that these high-profile people have been making for the last couple of years would all come to naught. So we will watching, that's how important those all-time high resistance levels are. We'll be watching them very, very closely, just like I did back in February, March, April of 2013 when those breakouts occurred, and I called the secular bull market back then. So more about that next week. Stay tuned. Silver is more or less following an underperforming gold, so we won't really analyze that. Copper got to resistance here at around about just under the $400 levels, fallen away again. Not a convincing breakout yet of this downtrending channel. So slight breakout back into the channel, but is in a little bit of indecision land here. There's a bit of a symmetrical triangle forming there, which I haven't got on the chart, but which would typically be a continuation pattern to the downside. For this to stand a snowball's chance of going higher, copper, which is important, as I've said before, because it is indicative of what can happen in small cap resource stocks and small cap stocks in general, and which are both underperforming the larger cap stocks at the moment. So I'm keeping an eye on mid and small cap. When it's relevant, we'll bring them into the conversation, but at the moment it's not. And this is one of the bellwethers that we'll be looking at as to when that happens. We should see them all happen at the same time. The main reason the CRB index, commodity index, has fallen away at resistance is oil. This is Brent Crude. So oil to stocks ratio down here. Oil underperforming and in that downtrend, needs to find support here. Pretty strong support zone between $70 and $75, and it's round about there at the moment. So let's see if that support holds and if it kicks higher. This is Bitcoin. I'll just go to this chart. Okay, Bitcoin, some weakness, strong trend, expect a retracement. Oh, sorry, I should bring this across here. That's why there's a bit of resistance there, strong resistance zone there. Just save that in. And it's found resistance at the resistance zone. Funny that happens so often. But just using a sort of a shorter to medium term indicator here, trend following indicator, the Siroc, I've got a 26.9 on there. Crossover, but in terms of trading this, if you're trading this with a kind of rules-based system, is you'd wait for the Ciroc to drop out of the blue zone, which is the 90 zone on the Ciroc indicator. This could go a bit higher, but certainly finding a little bit of resistance at the moment, but it's been a good run up. And Ethereum is much the same, hasn't quite got back into the trend like Bitcoin has, but there is a crossover there, and it would need to certainly rise to stay above the 90. So a little bit of weakness potentially ahead for those. Last three commodities to look at. Uranium is at this resistance of not much. You can't say that's a strong, which is why it's a dotted resistance zone. There's only a few touch points here, but it is higher than it. And there is the all-time plotted. We've got data going back to 1998 here. There is that all-time high over there. Lots of talk around the world with nuclear reactors, et cetera, et cetera. But this trend is certainly continuing up. Breakout on iron ore. There's this resistance zone, 125, 130 is a resistance zone that is and support zone. You can see it's got a lot of touch points here, and a breakout above that. Let's see if iron ore trends are stronger and the iron ore stocks will follow. But that's certainly an uptrend. It's broken out of the black channel there. It's broken out of the light gray channel line that I've got there, or trend line I've got there, and now is heading higher. Almost time to put in an upward trending channel over here, which I'll do for the next session when we do one of these. And lastly, thermal coal has found support, it looks like, and now is heading for this resistance zone, rising. And certainly playing by the textbook at the moment. Pretty steep 78.6% retracement here, which is what you'd expect, 61 to 61.8 to 76.8 or 78.6, given such a strong run-up. So let's see if this retracement is over. We'll know when it heads up higher than this resistance zone and starts heading up to the 50% retracement mark to see if it finds resistance there. Right, that is all of the. I'm just looking at any questions that anybody has. If not, we'll finish it there. That is all that I wanted to cover today. The summary is that we are in bullish conditions. The US portfolios, mechanical portfolios, have reacted very nicely, and we're waiting for some of the other markets. The DAX has as well, for the other markets to come along. But really what I'm looking forward now to seeing happen to really confirm this. The sentiment indicators are all there. Some of the breadth of market indicators are there. Is we now need the mid cap and the small cap stocks to join the party, and that'll be the last confirmation. And then to see what happens when all the indices get to their all-time highs. It'll be a little nice story to watch unfold and see what happens. Right, until then, what have we got here? There are some questions that we have. Okay, for AU dollar hedging, of course. Okay, done. Gary, have you had a chance to look at what you would recommend? No, I haven't done. I'm really out of that space at the moment of looking to see what instrument to use to hedge the US dollar. I don't do it. And so I'm not, when I have my head in it, when I did come up with the recommendations we had, I put significant hours, if not days, into working that out. And I'd have to do the same again. It's not worth a glance just to come up with something pretty quickly. And I'm not going to get an opportunity to do that in the short term. But if anybody's willing to have a look and see what instrument we can use now that the one that we did look at, which was a CFD of a futures contract on the Saxo platform, that would be good. But I'm not going to get a chance to do that given there's a bunch of other things I've got on my plate to do at the moment. So I haven't. Sorry about that. There is, right, any other questions? So I don't have a definitive answer on that, Don. My apologies. I'll see if I can get some time in the next few weeks. I know that the AU dollar hasn't gone ahead, but it'll also be platform dependent as well. So at the moment, that's the Saxo platform, and it would need a really good chunk of time to have a look and evaluate what's there's liquidity and availability and all that sort of stuff. Any other questions? No, John's just saying thanks. All right. If there's no others, you've got the message, you've got the summary until I do this again. So next week, I'm going to do a secular bull market update, and then I probably won't be doing another one of these until into the new year, probably the second or third week of January. So I wish you all a Merry Christmas and a Happy New Year. And 2024, let's see what it unfolds. Fourth year of the presidential cycle, and we'll talk a little bit about that next week in the secular bull market update. Till then, I wish you consistent, objective, and peaceful investing.